Big week of economic news in back-to-back fashion. You know, this whole concept of the Fed battling inflation. We got numbers on consecutive days. It hasn't happened that often where the decision on the next interest rate hike came right behind, 24 hours behind the inflation data. We do know, as we record this show on Wednesday, June 14th of 2023, the Fed is meeting. Yesterday, the inflation for May came out, and the data was good. It continues the trend down, and I think we're entering a time economically now. You know, we've talked about for months that one day it's bad news, one day it's good news. And I think we're entering a time now where it seems to be trending more good news than bad.
Well, the market has certainly had a trend upward since October. And all the folks that were predicting recessions, hey, newsflash, you were wrong. Haven't had one, and I don't really see one happening unless the Fed gets really, spirit driven by trying to attack inflation and not looking at the effect of a rising interest rate environment on business. And I think, Scott, it's probably good to just kind of go to school for just a second and have a little quick economic lesson on what's going on here. The Fed doesn't like inflation. Nobody likes inflation. And so their answer to try to tame inflation is to try to raise interest rates. Raising interest rates slows down things in the economy, and there's not as much turnover of money in the economy, and therefore that has an effect on interest rates. It has an effect on inflation rates, and we've seen that. We saw inflation go from, 8, 9, 10%, whatever it was, about a year or so ago. Now it's around 4 to 5%. And so the cause and effect is very clear there, that if you raise interest rates, you can have an effect on inflation. The problem is, and the balancing act that has to happen here, is that the Fed has to think about how that actually affects you and me and what we do in the economy. Obviously, raising interest rates slows down buying of houses. That has happened in the last few months. It slows down purchases of new cars because instead of 0 interest on a new car or 1% interest on a new car, you may be paying 6 or 7% interest on a new car. So all of that has the effect, and how far you turn that dial, you've got to create some sort of a Goldilocks almost effect here of not too much, not too little, get it just right, and you can have that soft landing that they talk about. And I think that's kind of where we are right now. And the markets have been, responding favorably because they've seen inflation going down, and they're anticipating the Fed kind of backing off a little bit on interest rate hikes, and we'll see how that goes over the next few months.
You mentioned the market, John, before we get to our first question. It really is interesting. I read today that the S&P 500 index is now within about 10% of recouping all of the losses given up during this bear market. It doesn't feel like that for people, right? But it's true.
No, it doesn't feel like that because everybody's telling you everything's going to hell in a handcart.
Right.
That's why.
Yeah.
And if you really look at the empirical data instead of the emotion, and this is where I get into, you need to look at facts over feelings. You really should look at what the data is telling you and not necessarily what the TV is telling you, because the TV wants you to be stirred up about something all the time, and they'll tell you it's bad, it's really bad, it's so bad I can't even tell you how bad it is. What the data will tell you is what's really going on. And the data has said since October that it's a good time to actually be in equities, and that's proven itself to be the case.
Yeah, very interesting because so many people sit on the sidelines during a bear market, during turmoil, and they say, I'm going to wait for things to get better. Well, if you wait for things to get better, by the time you know that they are better, the horse is out of the barn, right?
You missed it.
Yeah, and the S&P 500 index up 14%-ish year to date, and within 10% of reaching the all-time high it was at on January 3rd of 2022. So always a good time to be invested and stay invested if you maintain the long-term perspective.